Imagine this. You buy a rental, you hire me to do your cost segregation study, we show you a beautiful 6-figure paper loss, and then at tax time, your CPA says, sorry, you're passive, you can't use it. Most investors have no idea whether they're truly active in the eyes of the IRS or just along for the ride. And that's one mistake that can cost them more than any vacancy or bad tenant ever will. So today on the Tax Strategy Playbook, we're going to fix that. We're breaking down passive versus active real estate, what it really takes to qualify as a real estate professional, how material participation works in the real world, and the rules that decide whether your losses get locked up or unlock serious tax savings. And I've got one of the sharpest real estate CPAs I know, Gabe Virdaru, here to walk us through it step by step.
Welcome to the Tax Strategy Playbook, the show where smart investors, business owners, and real estate pros learn how to win the game the IRS wrote. Each episode, we break down powerful strategies, expert insights, and real-world examples that help you keep more of what you earn. Because here, it's not about working harder, it's about working smarter with your taxes, because tax evasion is a crime, but tax avoidance is mandatory.
Welcome back to the Tax Strategy Playbook. I'm your host, David Wiener. I am a cost segregation professional, along with 179D and D tax studies. Gabe, I'd like to welcome you to the show. You are the founder of Fortuna CPA. You work with over 300 investors on tax strategy, asset protection, and real estate planning. Thanks for joining us. This is a complicated issue.
Absolutely. Thank you for having me.
So, passive versus active. Can you just, in plain English, kind of define for the listeners what that is?
Absolutely. I think that's an important place to start and an important concept to grasp. But the main takeaway here is that all income is classified into one of two buckets in the eyes of the IRS. Like you said, there's passive and non-passive, also known as active, right? Synonymous terms. But on the non-passive side, the straightforward ones, the easy ones to understand, W-2 income, right? If you're full-time employed as a W-2 employee, that's going to be non-passive. If you're a business owner, you're running your own business in whatever industry there may be, that's going to be non-passive or active. Going a little bit deeper is where people start getting tripped up. Portfolio income, interest, dividends, sale of stock is actually also active. Logically, think about it, you might expect it to be passive, right? Because practically speaking, it is. You make an investment, you get a return. IRS doesn't see it that way. It is classified as non-passive. Retirement account distributions as well. Like if you're drawing on your 401k, IRA later on in life, or even earlier, that is considered non-passive. So that encapsulates the majority of active income, maybe with a few exceptions. On the passive side, rental real estate, traditionally speaking, and a big item of interest for the audience here, I'd imagine, is considered passive. If you're, and one example I'll give you before I pause, if you're a passive investor in a business, right, you're just bringing capital, but you're not actually involved in the operations of the business, that is also considered passive.
Do you find that there are misconceptions in a lot of people about what is passive and what is active, or they come to you and they don't even really understand the difference?
Great question. The latter. I'd say most people don't understand the difference, and when they do start thinking about it, it goes back to something I said earlier. They make the assumption that their portfolio income, if they have a significant amount of money in a taxable brokerage account, they're under the assumption that that's passive, because to them it is, right, compared to the work they put in at their W-2 or their business. And they are under the assumption, great, I have a nice investment account here. It's been not interest and dividends. I'll just go invest in some real estate. I'll use those losses from the real estate to offset the income that's being generated from my brokerage account. That is not the case. It is one of the biggest misconceptions. Anyone who goes down the tax planning rabbit hole, I think that's something they encounter early on, something important to clarify early on.
And it's really important for somebody, especially somebody who owns real estate, to do tax planning and tax strategy. I think you'd agree with that. So I laid out an illustration at the beginning. Somebody buys real estate, gets all excited about cost segregation. They do a cost segregation study. Have you had anybody who's done that then come to you and you say, you can't use this?
Yeah, and in a few unfortunate instances, yes. And then to your point, that's why it is so important to do planning ahead of time so we avoid those unwelcome surprises. Because you go through the hard work of sourcing a specific investment property, doing all the work that you need to do to, get it ready, get it placed in service, get it rented out, screen tenants, improve the property. You maybe did a little bit of research yourself and you find out about this wonderful thing known as a cost segregation study, bonus depreciation, only to come to find that you can't actually use the losses like you were expecting to.
And that's why I've heard that you don't let the tail wag the dog. If you're talking to a client, you actually help them in strategizing acquiring their real estate so that they can use it in a more significant way.
Exactly. That you want to handle that up front. I think the best way I could put this is you want to align the type of investor to the type of asset that they're looking at and the level of participation that they're open to engaging in order to structure that specific investment appropriately.
There are ways of making real estate active. So let's talk a little bit about ways of making real estate active or ways to realize that your real estate is active. Talk a little bit about the real estate professional designation with the IRS. I've had a lot of people who've said to me, "Oh yeah, I sell real estate. I qualify." That's not necessarily true. So talk a little bit about the tests that you have to kind of go through to determine whether or not you actually do qualify as a real estate professional in the eyes of the IRS.
Absolutely. Yeah, it's one of the most powerful tax strategies and also one of the most misunderstood as well. Before I get to the specifics of answering that question, I also think it's important to mention that if you do have passive losses and excess of passive income, going back to our example at the beginning of the investor that found out that they can't use the cost seg losses, passive losses can offset passive income. If you have passive losses in excess of passive income, they get suspended and carried forward. So you do get to utilize them at some point. I want to mention that as a starting point. But to
Yeah,
answer your
and we
question,
definitely want to talk about that as we go forward.
sure. Well, we could go through examples of how we can do that. But to answer your question specifically regarding real estate professional status, it is one of the main ways that we can recharacterize what would normally be passive rental losses, flip them over to the active side, and use those paper losses, use that wonderful bonus depreciation from the cost seg that you did against your active income. To your point, there are some specific rules that we need to meet. So to put it simply, step one, test one is that you need to spend 750 hours in a real property trade or business and more than half your time. Okay. So more than half your time, put simply, means if you are someone that is a full-time W-2 employee, generally speaking, you are not going to be able to meet real estate professional status. Common point of confusion that you correctly highlighted, the 750 hours in a real property trade or business, right? There's 11 real property trades or businesses as defined by the IRS. To put them really into three simple buckets, I'll say there's development, right? If you're flipping properties, that's one bucket, or developing new construction. If you're working as a realtor, that's another bucket. And if you're managing properties, either for yourself or other people, I'd say that's the third main bucket. So in one of those buckets or multiple, right? This is where it could get a little complicated. This is where the planning becomes important. We need to accumulate 750 hours and we meet test one.
So is there any way for a W-2 earner to meet real estate professional status? And what if they have a spouse that might meet it?
Great questions. So two separate things there. Let's assume both spouses are W-2 and one of them wants to go for reps. In general, I say no. We've seen a lot of tax court case examples where this has been unsuccessful. There have been people who have argued that even though I'm employed full time and I'm getting paid for doing 40 hours at work, the nature of my job, the reality of my job is that I'm not working 8 hours per day. So that people have tried to prove it, but generally they have not been successful. So I would love to see that first exception, right? And see someone successfully proven in tax court. But generally speaking, no. I'd say if you're full-time W-2, you're not going to be able to meet it. Going deeper into tax planning that I do with clients specifically, if it's a situation where one spouse is in a well-compensated W-2 position, the other spouse doesn't have full-time employment and they have the capacity to and the interest to spend a significant amount of time in real estate, that is a phenomenal position to be in. right? Because that spouse can meet reps. Other spouse is generating a bunch of income from whatever their occupation is, and we can use the losses at that point to offset the working spouse's wages.
They file jointly, correct?
Correct. They have to be married filing jointly in that scenario.
So what myths out there? I mean, you're going to have to prove, should you be audited, you're going to have to prove that you spent 750 hours and that it's more than 50% of your working hours. How do you prove that?
Great question. So with a time log, right, with a detailed time log, which I'll get into, but the what you asked about myths, and this is what I've had people who came to me get tripped up on in the past. We only went over test one. So it's important to mention that there's a second layer to reps, right? So test one is 750 hours and more than half your time. The second layer is that you need to materially participate in your own long-term rental portfolio. So that means you should have some properties, right? They could be residential, they could be commercial, they could be single family homes, they could be multifamily. That doesn't really matter. You need to be accumulating material participation time within your rental portfolio. So you should be self-managing to some degree. The myths and the painful lessons that I've seen people have to learn is, let's just say you're a full-time realtor, right? You're getting 750 hours working as a realtor. It's more than half your time. Well, if we don't have rental properties at all, right, there's no benefit really from a tax perspective. Or if we have rental properties, but you're not the one managing them, you have them under third-party management, that doesn't help you either. The step two is material participation within your long-term rental portfolio. There are 7 different material participation tests for the purposes of our discussion here. If we're talking about reps, generally speaking, you'll need 500 hours of material participation within your own portfolio.
Now, you refer to reps. That's the real estate professional designation, correct?
Correct.
Just
Sorry
to make
for using the
sure, for
acronym
people
there.
who may not understand that.
I'm so used to talking about it every day that I have a habit of shortening there. But yes, to be clear, real estate professional status, also known as reps. That's what we're talking about there.
Would you say that filing with, because you can elect real estate professional designation on your taxes, if you can't prove it, that might be a problem. Have you seen people who've done that and then paid later on when the IRS came to call?
Yes, I have seen instances of that. I've had instances where new clients came to work with us. Maybe in the past they worked with someone who wasn't too knowledgeable, or the client just told them, I want to claim real estate professional status on my return, but they're a full-time W-2 employee. We've had instances where we've encouraged clients to preemptively amend their returns and remove those non-passive losses, because you're right. If you get audited, the burden of proof is on you as the taxpayer. I think a good way of putting it, when it comes to the IRS, you are guilty until you prove yourself innocent. It's not like a court of law where you're innocent until proven guilty.
Kind of sounds backwards to me a little.
It is, but that's what we see play out in these audits, right? It goes back to your question earlier. How does someone prove this? Well, it is on you to prove it. It's not on them to disprove it. So the way you prove it is you have to have, ideally, impeccable contemporaneous records of that time that you're claiming that you put in. So whenever we get a client shooting for this, we walk them thoroughly through, another conversation we could have is what actually counts towards material participation. What kind of involvement are we looking at?
I definitely want to talk about that.
Perfect. So we can get into that, but it is on the taxpayer to prove it. So that could be on a simple Excel log. We have a template that we give to clients. It could be on a time tracking application like a Clockify, Toggle. There are specific apps that cater to this. RDPS Tracker is one that I've seen people use. So whatever tool that allows you to kind of, keep track of the time that you need to keep track of, that's what you should be looking at.
I have a client and a friend who is huge in real estate, definitely a real estate professional, but he told me that the first year he claimed real estate professional status, he was audited, and it caused the audit, and he spent a year defending it. He won, no problem, because he had all the contemporaneous records. But I've read court cases where the IRS has thrown a case out because the contemporaneous records weren't contemporaneous, because the IRS claimed they were all written in the same pen color.
Yeah,
They don't play.
Not at all. Not at all. Which again goes back to planning, doing things ahead of time rather than, and then the way audits work, you're going to get that examination later, 2 to 3 years down the road, right? If you didn't keep track of your time. One thing is like, yeah, the IRS fighting it that is not contemporaneous, and also the other thing is, how good is your memory really? Like, are you gonna remember what you did on March 11th of 2026 when you're doing your time log in 2029? Probably not. It's not going to be great.
Absolutely, yes. Now, talking about the real estate professional status, with a short-term rental, that's not required, right? Just the material participation. I know people call it the short-term rental loophole. I
Yeah,
don't like that terminology because it's not really a loophole.
agreed.
Explain that just a little bit.
Yeah, 100%. I'm with you. I hate the use of the word loophole there because it implies that it's something that's maybe
Sneaky.
not complete. Exactly. But this has actually been in the tax code for a while, right? So all of this stuff that we're talking about, passive activity loss rules, comes from Section 469. That's where the real estate professional status criteria is housed. And within Section 469, there is a portion there that says if you have a property with an average stay per guest of under 7 days, it is no longer a rental activity. So might sound a little weird, but practically speaking, what that means is that it is not subject to real estate professional status rules. So when that was written way back when, it was written and intended for your traditional bed and breakfast type of places and hotels as well. The reason is kind of getting this loophole terminology is that Airbnb, Vrbo, Booking.com, all these rental platforms became a thing and it just became a lot more accessible to your everyday investor.
That all happened before V or VRBO existed, correct?
Exactly. I believe 1986, I want to say, like somewhere around there is when that iteration was written. So it's been around for a while. So
It's
100% with you.
hugely popular now, and I would say probably uh, a good 30% of the cost segregation studies that I'm doing for people are for short-term rentals because it's a great strategy for a W-2 earner.
Exactly. Going back to our example, right? Like if you have both spouses or you're not married, right, and real estate professional status isn't attainable, and as I think we're kind of implying here with the criteria, real estate professional status, it's a lot of work, right? 750 hours. I believe if you do it over 52 weeks, a full year, it comes out to about 14 and a half hours a week. It is almost, at a minimum part-time job. Short-term rental strategy, as I like to call it, lower hanging fruit from a tax perspective because we keep the average stay per guest to under 7 days. And then we look at the material participation test specifically to that property or properties. Like I mentioned earlier, there are 7 material participation tests. The one we're most likely going to default to when it comes to short-term rental is 100 hours and more than any other individual. If we meet that test, the activity is active, we can do that cost seg and we could take those losses against the W income.
So that leads to another question. If somebody has, let's say they have a short-term rental and they're using a property management company, is it impossible for them to meet material participation?
Great question. I wouldn't say impossible, but extremely difficult, and it would significantly increase their audit risk. Because again, the test that we're likely defaulting to with one property is 100 hours and more than any other individual. If you have a property manager in place, and we could get into this a lot deeper in terms of when are you requiring it, when's the property manager coming into play. But broadly speaking, if you're engaging a property manager, they're going to be doing a lot of tasks that count towards material participation. I think this is a good opportunity to go a little bit deeper into what constitutes material participation and what type of time that we're looking at. It's the best way I like to put it at a simple level is it's day-to-day activities and operations that make the property go, right? It impacts the actual operations of the property. Anything that is maybe too easy or too good to be true typically is too easy or too good to be true. So I always like to go over time that doesn't count because these, when you're having these conversations with people, this is where their minds gravitate because it's the easiest pathway to get their 100 hours in their mind, right? So some big buckets of time that are generally disallowed: travel, that's a big one, and it's
That
kind
is
of an eye opener
disallowed.
for people. It is disallowed. Travel time is disallowed for material participation purposes. People like investing in short-term rentals out of state. A lot of people from California will buy short-term rentals, different markets. That's a good example. If you're flying out from California to, let's say, Florida or Tennessee, the time it takes you to get there, including time to get to the airport, time on the plane, time to get your rental car and to get to the property, that does not count towards your 100 hour. So that's one big bucket that's disallowed. Another one that people gravitate towards: education and research hours do not count as material participation. We've seen them disallowed in court cases over and over again. So our podcast here today, if you're listening to this and learning more about the short-term rental strategy, you may think that, hey, I could count this towards my 100 hours on my current property or maybe a future property. Not the case. Again, it goes back to what I said at the beginning. We are looking for time that makes the property go. Does our conversation here today make your specific rental property go? The answer will always be no. So those are two of the main ones I'd like to kind of point out.
You're not saying, though, that somebody can't meet material participation with a remote property.
They absolutely can. It's a great question there. And I see it done all the time. I'd actually venture to say that I see people do it remotely more oftentimes than locally, just because of the nature of short-term rental markets. It is doable. So I'll give you maybe like a little case study example that I see play out over and over again of how it's doable. Going back to the example of someone purchasing an out-of-state property, there's a lot of work that's associated with getting the short-term rental ready, right? Like the thing I always like to tell clients is you're getting into the hospitality business, it's not just a real estate investment, right? You're providing experience to people. So with that, you have to provide a furnished property that has absolutely everything that a guest could possibly need, and amenities as well, generally speaking. Those furnishings and those amenities need to be set up by someone, right? It's a twofold benefit if you do it yourself. One, you're saving money on paying someone else to do it. Two, that is a great example of material participation. If, let's say, a married couple flies out to their Florida short-term rental and they spend a weekend, maybe a long weekend, the Thursday to Sunday, working on that property sun up to sundown, because there's a lot of time, work required for that property, and there are a lot of things that need to be done. That is a great way to get a bunch of material participation hours in a short time period.
Very good. I have seen a case, I believe, where people do use a property manager, but they do it with material participation in mind. Keep track of what the manager does and what they do so that they meet and if they do 500 hours, it doesn't really matter, correct?
Correct. 500 hours, I say, is the holy grail of material participation because no one else's time matters. And that's what I was alluding to as well with the timing of the purchase, right? Because a lot of the time up front will come on the setup. So if the investor is willing to dedicate their time to the setup and it's a purchase later in the year, conceivably that could work. I just hesitate to flat out say, yeah, you could meet material participation with a property manager. You can in certain instances, but you want to be very careful how you structure it, to your point, if you're going down that road.
You have to plan ahead for that and make sure that
Correct.
you're keeping track of pretty much everything. Is there a lot of miscommunication between investors and CPAs when it comes to material participation?
Yes, I'd say so. And a specific example is the short-term rental strategy. I've seen a lot of CPAs and preparers not familiar with this strategy. So kind of goes back to your example at the beginning, right? It adds an additional layer. You as the investor educated yourself on the criteria that you need to meet for the short-term rental strategy. But if you're not proactive in working with your CPA or your tax preparer, when they go prepare your taxes, I've seen, preparers argue with clients, hey, you're not a real estate professional. We can't use these losses against your W-2 income, because they're not familiar with the short-term rental strategy, which again is separate from real estate professional status in this case.
I've also run into plenty of CPAs in my years doing this that don't understand cost segregation. They don't understand bonus depreciation. They don't understand real estate in general. And so I'm constantly harping on my clients, if you're going to do this, you really need one, you need to have tax strategy, not just tax preparation. Please don't be using TurboTax and trying to do it yourself. And two, you need to make sure it's somebody who has a background with real estate and thoroughly understands real estate and the ins and outs of that, because there's a lot they could miss if they don't. Am I right?
100% agree with all that. You want to be proactive up front. You want to start the conversation as early as possible, especially with your CPA or tax preparer. And you want to work with someone that's knowledgeable because, to be clear, we're covering the surface level here. There is a lot of nuance to each specific piece of these strategies, and you could get tripped up on a nuance and not have the outcome that you want to have. Like, for example, common questions that come up, I'll just list out a few off the top of my head. For the short-term rental strategy, average stay per guest needs to be 7 days. Well, how many stays do you need to establish an average, right? If you're dealing with a later year acquisition, is it enough that I've acquired a property and my intent is to treat it as a short-term rental or to rent it out as a short-term rental, but I didn't actually get any stays in the current year? The answer is no, it's not enough. Generally speaking, we need at least 2 stays in order to establish that average of under 7 days.
And this is
Right.
stays at fair market value, correct?
Correct.
And it's not something where if you get a property ready by December the 20th and you get a couple of friends to pay you $1 and stay there over the week. You can't use that, right? I believe
Exactly.
for a long-term rental, as long as you have it advertised for rent, you can consider it placed in service, but not so with a short-term rental. That's really important, and I'm glad you brought that up.
Yeah. That's just one specific example of a nuance. And even that, to clarify, it could be considered placed in service if it's available to rent. But if you didn't get the stays, we're not qualifying under the short-term rental criteria. It could be placed in service, but it will be treated as a long-term rental, right? Because we didn't establish the average period of customer use. And to your point, because yes, I've seen this come up time and time again, in an ideal world, they are legitimate stays through a booking platform that you have support and history of. There's actually, if you look in section 288, if you have a family member rent a direct family member, so that's going to be someone like a parent, sibling, um, daughter, son, etc. If they rent the property from you, even if it's at fair market value, that's actually counted as a personal use stay to you that's not their primary residence, which is short-term rental is not. So that's another tripwire that I've seen come up, and it's just kind of reiterates what you said. You want to get ahead of all this and plan it ahead of time, or else you might walk into some of these unwelcome surprises.
And you don't want those surprises in an audit. You want to know ahead of time so that you can provide for it, plan for it, and be ready. Just a little bit about passive loss rules, because if real estate is passive, there's traps. There's opportunities, but there's also traps. So how do the passive loss rules work?
So going back to the conversation at the beginning, and like you said, real estate is inherently passive. And let's pretend we're not applying with the real estate professional status or the short-term rental strategy. Then those losses will stay on the passive side. The way it works is that they can offset passive income. So this the most simple example of this I could give is rental property A has a $10,000 of income after all expenses and depreciation. Rental property B has a $5,000 loss. We can use the $5,000 loss for rental property B to offset the income from rental property A, and our net taxable income from those two combined properties is $5,000. That's the easy example. On the flip side, rental property B has a $10,000 loss and rental property A has a $5,000 worth of income. That $5,000 excess loss, unless you qualify for the $25,000 allowance based on your income, which we could cover. But if you're in a higher tax bracket, that loss is going to be suspended and carried forward to the future.
So talk about the $25,000 allowance and how that works.
Yep. So that's if you're under a income threshold, if you make under 100K, you can use up to $25,000 of rental losses against your active income. I believe 100 to 150K is the phase out range. It phases out $1 for every $2 of income. So at $150,000, you are fully phased out from being able to use that $25,000 allowance. It is the same threshold whether you're single or married filing jointly. It's something that hasn't been adjusted for inflation in years, which is a little bit frustrating. Maybe a conversation for another time. But yeah, if you're not in that income threshold, if you're above that income threshold, I should say, can't use anything. You don't have any allowance. Everything gets suspended and carried forward.
So how is it carried forward? You can use that loss next year against passive income?
Correct. So it gets carried forward on Form 8582. One takeaway from this conversation we're having here, anyone that's listening to this that has rental properties and they're unsure of what's been reported in the past, I'd take out your most recent filed tax return, look at Form 8582, and see what your suspended passive loss carry forward is. A lot of people don't know about that. They don't track it. It's an important number to be aware of because it does impact planning going forward. It gets carried forward on Form 8582 and it unlocks against future passive income. Some examples of that, the simplest example is we have income from a rental property, or if you sell a property in a portfolio, that is a passive gain from disposition, and those suspended passive losses can be unlocked at that point.
So you can use it against the gain on a future sale.
Correct. Future sale of a rental property.
Okay. But cost segregation cannot offset capital gains, correct?
You could in that instance. So if you
In that instance, yeah.
Yeah, in that, so the passive gain from the sale of the property unlocks your passive losses. If you are in a position, and then this goes back to planning and strategy. You'd want to look at what your passive losses are, and you want to estimate what your passive gain from the sale of the property will be, and kind of see where we're at. If you have maybe, I think this is where you're going with this. If you have another acquisition in that same year, separate from the property that you sold, one potential strategy would be to look at cost segregating that new acquisition and use the resulting loss to offset the gain on the one you sold. So it can be used. The way it works, though, and this is a common misconception, those suspended passive losses actually go against your ordinary income. So the capital gain of the sale of the property is what unlocks the passive loss. It's what allows you to use it, but it offsets your ordinary income. So you're saying it's actually a great strategy to look into. If you're in the 37% bracket, those suspended passive losses are offsetting income in the 37% bracket, even though you might be paying 20% capital gains on the actual sale.
So it becomes even better than a wash. That's great to hear.
Exactly. Exactly. Something that's oftentimes missed. But if you trace
I
through the forms,
I try and educate when somebody comes to me for a cost segregation study and they don't understand it. I try and make sure that I ask those questions. Do you qualify for reps? Are you materially participating in the property? Because I think responsibly, I should not be trying to sell somebody a cost segregation study who
sure.
isn't going to benefit from it. I can't be their CPA. I can't answer CPA questions, but I can make sure that if I offer them something, it's going to help them, at least to the best of my ability. Let's take a particular case, a hypothetical case. If somebody has, let's say, $100,000 paper loss,
Mhm.
what happens if it's passive? What happens if it's non-passive?
So I'll take the more attractive one first. If it's not passive, let's say you jump through the hoops of the short-term rental strategy. That $100,000 offsets your active income dollar for dollar. So if you're making $250,000 from your W-2, whether you're single or married filing jointly, that $100,000 nets against your W-2 income. So rather than paying taxes on $250,000, we are now paying taxes on $150,000, right? So we always look at the savings based on your marginal bracket. So if you're in the 24% federal marginal tax bracket, you're saving $25,000 in taxes, net tax savings based on that $100,000 loss. If it's in the non-passive bucket, great position to be in, right? That's why people cost segs and bonus depreciation and 100% bonus being back. Um, if you're on the passive side, the first things that happens is we look, right, you're preparing the tax software, it looks, do we have any passive income to net this against? If, let's say we don't, that $100,000 carries forward on Form 8582 of your tax return to the following tax year, and it just sits there. In the next tax year, when your return is being prepared again, you look, do we have any passive income to offset this against? If we do, you can use some of it then. If not, it just continues to carry forward until we do have some passive income.
Let's say somebody buys a property in 2026. Good for 100% bonus depreciation. Everything looks good. And they decide it's going to be a short-term rental.
Mhm.
So it'll apply to their W-2 income. They take it against their income. They file their taxes. They get the great tax benefit. What happens down the road if they decide to make it a long-term rental?
Great question. Yeah. A bit of nuance to that question. So nothing happens in terms of the depreciation is not recaptured once you make it a long-term rental. It just sits in the adjusted basis of the property. But the bigger question is, what was your intent? That's where the audit risk lies. So your intent in running a property as a short-term rental, it should be a genuine intent to generate a profit by operating the property as a short-term rental. Where you could get in trouble if you're audited is if your intent was to just place it as a service as a short-term rental, use it against the W-2 income, and immediately change it to a long-term rental afterwards. That's where the risk lies. So that's what I caution people if they're thinking about doing that.
So if you're putting a property into service in December, in January, you don't want to change it into a long-term rental.
Absolutely not. That's clear cut and dry. You want some long-term rental history. You want a genuine intent as operating as a short-term rental. If you do switch it to being a long-term rental, you should have a great explanation of doing so other than I already got the tax benefit. I don't want to deal with it anymore. There should be a rule or a law passed with a specific county or city that you can't run it as a short-term rental anymore, or some other documented proof as to why you did that.
And there are a lot of communities now that are restricting and banning short-term rentals. I know I deal with a lot of properties in California, and there are
Yep.
certain areas where they just won't allow it anymore.
Yeah.
So let's say I'm an investor. I have $100,000 to $300,000 worth of suspended loss. What one or two moves should they be discussing with their CPA or their tax strategist right away?
Great question. The easiest one is, can we generate some sort of passive income? That's much easier said than done. If it was that easy to do, everyone would do it, right? Um, it really depends on also what your background is. Like, I'll just throw out a random example here since we do a lot of work with physicians and doctors. If you're a physician or doctor that's in that situation and you could invest in something like an ASC, an ambulatory surgery center, that's an investment that spits out a bunch of passive income. That would be a great strategy for someone in a position like that. But not everyone's in that position. So the answer that I would give here is I would take a good hard look at your portfolio overall, meaning each property that you own, look at the metrics, run the number with your preparer, with your CPA, with your bookkeeper. What's the ROI that you're getting on these properties? A great metric for this calculation or for this analysis, return on equity. How much of a return are you getting on the equity in the properties that you own? And when you run through that exercise, sometimes the answer becomes clear. If you have one that's a bit of a laggard, it's not really generating much, it's more of a problem property, but we have a good amount of equity in it, we could sell it and we could run an analysis on what the taxable gain is, and we could see how much of those suspended passive losses we could tap into. That way we free up the capital in a tax-free manner. We're tapping into the suspended passive losses, but we're also freeing up that equity that you weren't getting great return on for you to reinvest in another property or another investment that will generate a higher return.
Fantastic. If a listener to the podcast only remembers one or two things you said, what are the one or two most important things for them to remember?
Yeah, great question. As a starting point, I think it's important for every taxpayer, every investor to have a very clear grasp on their income sources. So if there's one thing that you take away is kind of on paper, jot down what your income sources are, what your investment sources are, and you have a very clear understanding of what's in the passive bucket and what's in the non-passive bucket as a starting point. And then assuming you're already a real estate investor, you already own some properties. The other takeaway here is go look at your tax return, look at Form 8582 and see if you have any carried forward suspended passive losses.
Because
Both
they
really
may not
important.
realize it.
Exactly. And that will affect what their strategy is.
Give me a few steps that listeners should do to make sure they don't get surprised at tax time.
Yeah. I'd say be proactive. if you have a CPA that you've been working with for a while, but you've kind of gone down a different path of investing in rental properties and real estate in general, bring up the conversation early, tell them what you want to do and see what the response is, right? Are you going to get proactive support and are they willing to work with you? Or are you kind of, getting some vague answers and getting brushed off? The earlier you bring up the conversation, the clearer your path becomes.
This is the playbook after all.
Exactly.
So we're kind of wrapping up here, but I do have a question for you. In your life, I heard that you were formerly a pro soccer player. How do you go from professional soccer player to Fortuna CPA?
Love getting that question. I always like to say it's the most common feeder route of becoming a CPA is playing pro soccer when you were younger. But no, yeah, I was fortunate to have the opportunity to play soccer a little bit. Played growing up in my younger days. Played a little bit in Eastern Europe in Romania after high school, and then goes without saying, didn't necessarily work out for the long term. Still a great experience overall, but ended back up in school, in college. Had no idea what I wanted to do at that point. Thought I was going to become an agent, funnily enough, kind of stay within the sports world. Took a introductory accounting class, took an introductory tax course, kind of got hooked as much as one can get hooked on taxes and tax strategy and really went for there. And through real estate investing on top of that and kind of found my niche at this point, doing something that I generally enjoy doing in the tax world and in real estate.
So you mentioned working with doctors and physicians with Fortuna CPA. What clients do you serve?
Yeah, I'd say anyone who has an interest in real estate, people who maybe have been lacking planning or haven't had access to good planning in the past. If you're a high income W-2 professional or if you're a business owner that has been investing in real estate or is interested in investing in real estate, and on top of that is interested in coming up with a proactive tax strategy to implement using the real estate you require, those are the types of people that we're looking to work with. So we are very much advisory focused and planning focused. We like being proactive and working with clients up front, educating them and working hand in hand to create a plan that they could implement and have guidance through the implementation phase. That's what we
I will put
specialize in.
all of your contact information in the show notes so people will be able to get in touch with you if they like. But what's the best way for them to get in touch with you?
Yeah. I think that the best way, if you're interested in having a conversation about becoming a client, will be to go to our website, fortunacpa.com. You'll see a link there to book a consultation. There'll be a simple form for you to fill out, kind of giving us some of your background, and then schedule a call and go from there.
That sounds great. Well, Gabe, I appreciate you being with me. This is a subject that comes up all the time, passive versus active, and how do you qualify, and how do you know if you qualify, and that sort of thing. I think we have pretty much given them an area to work with and some questions to ask their own CPA. I appreciate you joining me.
Absolutely. Thank you so much for having me.
And if you'd like to go back and review some of the things that we talked about, visit taxstrategyplaybook.com/4, and you'll find all of that, including a one-page PDF that you can use for your own strategy and planning and determining whether your real estate is passive or active. If you'd like to consider becoming a guest with me on the Tax Strategy Playbook, go to taxstrategyplaybook.com/guest. And if you're interested in further information about cost segregation, bonus depreciation, 179 or R&D studies, contact me directly. My contact information will be in there as well. And I look forward to seeing you on the next episode of the Tax Strategy Playbook.
Thanks for listening to the Tax Strategy Playbook. If you found today's strategies valuable, be sure to subscribe, leave a review, and share the show with someone who wants to play smarter with their money. You'll find more resources, tools, and expert tips at taxstrategyplaybook.com. After all, it's your money. Keep more of it.